welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we talk about the latest trends in the stock markets, also help you really understand which are the sectors and the stocks that are buzzing in trade. We also get you the expert views on markets as to how should you as investors be approaching the stock markets now, also to help you understand which way are the markets headed. All of those things will also be discussed, but today the focus will also be on the lock-in period ending for the pre-IPO investors of the new age tech stocks. So what really happens in the month of November as 9-10 of these IPOs that got listed in last year, all of those pre-IPO lock-ins get over in the subsequent days as well. We'll get you some views on that as well. For now, if you look at the markets, 60 points down for the Sensex, 61,124 points at this point in time. Also the Nifty 50, 18,190, which is just about 12 points down. So the markets are hovering near the flat line with a negative bias at this point in time. The only sector that's shining bright in today's trading session is the PSU banks that continues its run from Monday and from the previous week as well. So 3.5% uptick can actually be seen on the PSU banks. That's taking the lead forward. What's not performing is the autos, financial services, the realty stocks. Those are the stocks that are not performing. Metals and pharma also dragging a little bit. But it's the PSU banks that are showing some considerable move on the upside. Let's welcome our guest for today. Mr. Avinnash Gorakshakar joins in Director Research at Profit Mart Securities. Welcome, sir, and thank you so much for taking the time out for this discussion. Well, we are hovering near about 1-2% away from those all-time high levels of the markets. There is, a sense that the FIs are coming back. What do you sense as far as the markets are concerned? Are we looking at better times ahead? Are we heading towards the newer highs and record highs as well?
Yeah, first of all, thank you, Sakshi, for inviting me. I think the markets have, rallied significantly. I think largely on the back of, again, strong FI interest coming back in the markets. And obviously, retail money, that is SIP flows, have also been pretty strong. So I think, the markets are on a strong footing. What we are seeing today is some sort of partial profit booking, because I think the markets definitely would like to consolidate before they take the next move going forward. My sense is that now going forward, the index may consolidate for some time, but there could be a lot of stock-specific opportunities across many sectors. We are still in the midst of the Q2 earnings season. And by and large, companies have presented very strong numbers. So I think very few negative surprises. And overall, I think the mood in the corporate sector seems to be quite upbeat. So macro numbers are also pretty strong. GST numbers, or for that reason, tax collections have also been buoyant. I think now, Sakshi, just one thing to add would be the markets are now looking forward to the budget. The budget is going to be a key trigger, because this is a budget just 1 year ahead of the general elections. So I think the mood in the markets is definitely going to be positive till the budget is presented.
Okay, understood that. We'll talk more about the markets going forward also. But right now, as I said, the focus of this video is going to be how the D Street is really bracing for that $14 billion test. Now, what is this test? November as a month may actually see a huge supply of shares as the lock-in period of 10 companies, including FSN e-commerce, that's Nykaa, PB Fintech, that's the parent company of PolicyBazaar and PayTM as well, Sikaji Industries, 197 Communication, that's PayTM, Tarsan Products, Go Fashion will all end this month for the pre-IPO investors. Now, we also will see that this will allow billionaire backers like Masayoshi Son's SoftBank Group and even Warren Buffett's Berkshire Hathaway and Jack Ma and Group, who have been the pre-IPO investors in some of these, also an opportunity to exit. Now, is that a big concern? Will we see further sell-off in these particular stocks is the focus. So, Mr. Gorakshakar, help us first understand, for the benefit of all our viewers, why is this lock-in period being discussed as a worry sign, as a big concern?
See, I think, Sakshi, for all these 8 to 9 companies, pre-IPO money is something which is, allocated to institutional investors, and there is a lock-in period of 1 year. So typically what happens in the markets is that once the lock-in period gets over, we see a significant bout of selling from these investors, because they are free to sell these shares in the secondary market. And historically, it has been proven that whenever the lock-in period of 1 year gets complete, these pre-IPO investors definitely decide to book out either the gains or losses, depending on what are the kind of valuations for these companies, what is the kind of growth outlook for these companies. So I think in the near term, as you rightly pointed out, there's a huge worry of a fresh supply wave in of paper in these companies. And typically, most of these companies have incurred losses. So I think investors who want to get more liquidity would prefer to exit. So
Okay.
in that perspective, this is definitely a very crucial month, that is November. We may see a lot of supply across all these companies, at least in the near term. Afterwards, it's going to be earnings which are going to support these companies if at all they do perform better.
Okay, but the big worry that all the investors are looking at is that can these shares fall sharply if we see exits of some of the noted investors or the pre-IPO investors? We've already seen some of these companies showing a sharp decline from their issue price of even 50, 60% odd, 70% to some extent as well. So further from here also can we see, erosion of wealth?
See, I think my sense is I think businesses which are very strong inherently will definitely continue to do well. But I think businesses which are not incurring any operating EBITDA positive
Okay.
or which are burning cash significantly, I think these are companies which inherently now investors have realized that these are quite expensive because there is no concept of valuations here. So I think you
Yes.
could see further fall in such kind of companies. But wherever companies are making an operating EBITDA which is cash positive and where the growth prospects are decent, you may find that the fall may be temporary. So companies like Zomato, or for that reason PayTM, these are companies where possibly it's going to be a long way ahead where the investor can really hope to make some money. So depending on the kind of cash flows generated and the kind of operating profitability, I think it's going to be quite stock specific. But across the board, some selling will be felt initially, and obviously the ones which don't make cash flow are going to see a further fall, even if the stock has fallen by 50-60% in the last 12 months. So that's going to be the story, at least, which all investors need to face.
Okay, and I'm very glad that you made that point about valuations because I was coming to that itself. Remember when these stocks had listed amid much fanfare last year, there was a whole talk among the analysts as to how we will have to value these companies much differently. The metrics will have to change because they're not making profits on the bottom line as of yet, but the kind of expansion they are doing, the different business models, the kind of acceptance among the millennials that there is for such kind of new models is going to be there. But after this 1 years of performance, where we have seen most of them, in fact, make substantial decline on the stock prices, does it really make sense that come what may? Bottom line and the traditional valuation metrics are going to stay, and that is exactly how the investors are going to value them.
So I think, Sakshi, you have made a very valid point that even if these companies are not purely manufacturing companies, I think what is important is that most investors, especially the retail investors and the institutional investors, have realized that unless the business makes a decent amount of cash flow
Hmm.
and there is hardly any cash burn,
Hmm.
the markets would obviously reward these companies with better valuations, and it's vice versa, exactly the opposite. If companies burn cash continuously and don't report earnings cash positive on a slightly medium to long term kind of time frame, then these companies are definitely not going to be valued on metrics like price to sales or market cap to revenue, because inherently, if there is no cash flow, the business is not going to survive for the longer term. So I think you're right. These kind of metrics will change, and I think markets have already discounted these companies.
Yeah.
Another thing which I wanted to tell you is that most of these new companies have issued bonus shares. That is one
Yes.
other big worry for these companies.
Yes.
Nykaa has given a 4:5 bonus, so now the stock would be 200 rupees. So people may think it's a cheap share, but it is
Yeah.
not a cheap share because obviously supply of equity is going to increase and the earnings
Hmm.
dilution has been quite significant. So even this fact needs to be kept in mind by incoming investors.
Very important point for all the investors to note right here. But on the contrary, there will be a whole lot of investors who perhaps didn't invest in these stocks back then. For some or the other reason, they didn't get the allotment, and then when they rose sharply on the listing days, they actually did not invest. Now, when these stocks are down by 40, 50, 60 odd percent, does it make sense to invest in any of these stocks at this level? Do the valuations make sense now?
See, I think my sense is, there are going to be some interesting companies like Tarsan Products, which is into the medical equipment space, Ethos, which is into the luxury product space, because there's a lot of interest by the investing community,
Hmm.
as well as there's a huge market which is left to cover these products. So I think every company will be evaluated based on its business model. And I
Yeah.
think there is no need for any investor to rush in. I think you're going to get ample opportunities, for to accumulate stocks here. So I think once the lock-in period ends, I think it would probably take a long time for these, stocks of all these companies to recover fast. Because typically, when the share price trend gets broken, it takes at least 3 to 6 months before earnings support the stock prices again. So I think one can look at maybe two or three companies which I mentioned from a long-term perspective, provided the cash flow is there, the business is growing. But typically, cash burn companies, loss-making companies are unlikely to move up very fast in the very near term.
Okay, understood. Like you pointed out about earnings, I wanted to understand from you, out of these stocks, out of these companies, are there any earnings so far that have come out that give you a promising outlook? We did see PB Fintech coming out with narrowing losses on the bottom line as well. As far as the revenues are concerned, they reported doubling of the revenues on the top line. So any of this really looking promising to you? Same way for PayTM also, losses getting narrowed. Is that a promising sign?
See, I think losses getting reduced is a promising sign, but it's still a long way off. And I think even today, Paytm, commands a market cap of almost 42 to 43,000 crores. Now, if you look at, some of the private sector banks like Federal Bank, which is a very profitable bank, this bank commands a market cap of 28,000 crores. So, valuations still appear to be slightly expensive. And I think,
Okay.
if you look at the numbers from Tarson or for that reason, Paytm or PolicyBazaar, I think one thing needs to be understood is that the management of these companies has always been positive. But
Yeah.
if you look at the numbers, I mean they have been giving unpleasant negative surprises on the earnings. So I think it's better to wait and watch rather than making a hasted entry at current levels.
Right. So you talked about Tarsons, but let me also talk about, say, Latent, or let me talk about Go Fashion for that example. These have been the outliers in the last 1 year or so, because they have actually seen the stock prices rise by almost 90 odd percent. What's next for these companies who've actually performed to and given a lot of wealth creation to the investors of the IPO, pre-IPO, and the early investors?
No, exactly. I think if you look at Go Fashions or Ethos, my sense is these companies have definitely delivered well on the numbers. Go Fashions has delivered a lot of wealth for not only the retail investor but even the institutional investor, and the business is growing. So I think in such kind of companies, Sakshi, even if there is a pre-IPO investor who's selling, you may not see the entire quantity being offloaded by the pre-IPO investor, because even these investors have made a decent amount of money. So obviously they would also not like to liquidate their positions fully. So probably in such kind of companies, if there is a fall, you get a
Yeah.
temporary blip on the stock price. That would be a good opportunity to accumulate these companies, to create a good long-term portfolio.
Okay, so in the end, help me understand, and all the viewers also, that if one were to look at these companies with a fresh perspective now, which are the companies that one can still hold on to if they are already invested, look at as a fresh buy opportunity even now, and which ones would be a complete avoid and stay away from at this point?
See, I think Sakshi, I would comment on the avoidable list first. I think
Okay.
Nykaa is avoidable because I feel that the stock is still quoting come bonus. When it goes X bonus, we could possibly see a level of 200 rupees, and the 4:5 bonus has been very very liberal. It's going to dilute the equity in a significant manner. Second is Policy Bazaar also seems to be struggling. So there also I would be a little apprehensive, and even Paytm for that reason. Markets are awaiting that September 23 the company becomes cash positive. Till that time, I think it's avoidable. The only companies which I think look interesting are Go Fashion, which I mentioned now. I think very strong numbers, very strong retail franchise. Then Tarson Products, which reported a softer quarter 2, but I think promising prospects for the longer term. And Ethos, which is into the luxury product segment, which does a marketing of watches and now have decided to enter the hard luggage segment, would be interesting bets. If you at all get a chance to see if the stock prices correct sharply in the month of November.
Okay, understood that. Well, on that note, thank you so much, Mr. Gorakshakar, for being with us for this entire discussion on how the lock-in period would actually impact, and the for all the pre-IPO investors. How do we see that really playing out for a number of these stocks which have already had a tough year, and now come November with this lock-in period getting over, how will these stocks really perform going forward, and what is the approach that investors should take to all of these? Thank you very much. It's been a pleasure speaking to you as is always, and good to have you back.
Yeah, thank you.
All right, and with that, we will close this edition, but keep an eye out on how the markets are performing at this point in time. 75 points down for the Sensex, 61,109, and 18,186 for the Nifty. Both the indices are right now trading flat with a negative bias, just down about 0.1%. But how soon do we see a bounce back from here is something that we will keep an eye out on. From the last 2 or 3 odd trading sessions, every time we are seeing that last 1 hour move really come up, and the market's taking a bounce from the last 1.5 hours. So we'll keep an eye out on that, and do stay tuned on to Business Today TV for a whole lot more update on the markets coming up right up on your screens.